Hello and welcome to the Accounting 2208 video lecture on Chapter 13, Current and Non-Financial Liabilities. This video is intended to match what would be covered in a typical Accounting 2208 class for Chapter 13. However, not all concepts are included in the video, which, like a classroom lecture, is intended to supplement, not replace, the textbook and chapter resources. It is therefore expected that you have read the required portions of the chapter prior to viewing this video. Let's begin. So in this video, we'll briefly review what a liability is and discuss the difference between financial and non-financial liabilities. We'll look at notes payable, specifically interest and non-interest bearing notes. We'll look at the major concept area, which will be completely new to you from your intro accounting, which is product warranties. So we'll look at assurance type or expense warranties and sales type or revenue warranties, which are also known as extended warranties. We'll look at some details around presentation and disclosure, briefly discuss contingent liabilities, and look at a couple of common ratios that you'll need to know. This is a snapshot here of the coverage in the textbook on non-financial and current liabilities. And you'll see basically we cover most everything here. We look at recognition and measurement liabilities, what are common current liabilities that include, bank indebtedness, accounts payable, short-term debt, dividends payable, etc. Now, even though we focus only on notes payable and warranties in the video, all of these other items are fair game and testable and are included in selected problems. We don't cover employee-related liabilities, and we don't include decommissioning and restoration obligations as part of non-financial liabilities, and we don't look at customer programs. So we'll look at product guarantees, yes, and then just briefly discuss contingent liabilities. And then you'll see the part on presentation and disclosure and some analysis and ratios. The bottom part includes a list of the omissions for the chapter, so with the page references, and that's a snapshot out of the syllabus. You probably already know what a liability is, sort of conceptually. It's basically something that you owe somebody. But here's a snapshot of illustration 13-1 from the text that basically identifies liability as an obligation that arises from past transactions. And it has three essential characteristics: that they embody a duty or responsibility to others, so you have to do something. The entity has little or no discretion to avoid the duty, so you basically have to do it or give the money back, let's say in the case of unearned revenues. And the transaction or event that obliges the entity has occurred, so something has happened. So in the case of unearned revenues, somebody has given you, a customer has given you money in advance for doing work. So that transaction has already occurred. Now you either have to do the work or you have to give the money back. So now I'll just briefly discuss the difference between financial and non-financial liabilities, and that may seem like a bit of a weird thing to discuss. We're talking about financial accounting. It's all about dollars. What's financial versus non-financial? Well, basically, a financial liability is anything that is a contractual obligation and that's typically settled or delivered in cash or other financial assets, right? Whereas liability basically is something that usually isn't payable in cash. So unearned revenue, right, is a really good example of a non-financial liability, because somebody gives you, they give you cash to do the work, and the idea is that you'll do the work, not give them the money back, right? It's only in the case that you don't do the work that you would end up giving the money back, but we classify that as a non-financial liability because you have an obligation to actually perform a good or perform a service or provide a good. So that's the simplest example if you ever to be asked, financial versus non-financial liability. So a financial liability is accounts payable, income tax payable, royalties payable, anything that you have to pay in cash, and a non-financial liability, unearned revenue, is a really good example. You might have been exposed to a very simple type of notes payable question in your introductory accounting. So basically, I will just talk about those quite briefly. So a note payable is a written promise to pay a sum of money in the future, right? if you think of a mortgage or a large bank loan that's payable over a long period of time, that's actually not a note payable. It's a long-term item. Usually notes payable are short-term. They can be non-current or long-term as well, but they're usually typically short-term, and they may be interest-bearing or non-interest-bearing. So just basing an example in the text of how you would account for notes payable, they're pretty simple. And we'll start with an interest-bearing note. So here, a provincial bank agrees to lend $100,000 to Landscape Corp on March 1st, and the company signs a $100,000 4-month 12% note. So that means the note bears interest at 12% and is payable in 4 months, right? And the journal entry to record that basically on behalf of the company that is borrowing the money, right? In this course, we're typically looking at the perspective of the borrower, right? Because we're looking at the right-hand side of the balance sheet, which is the liabilities and shareholders' equity section. So a note payable is the one you're borrowing. So you would debit cash for $100,000 and debit the note and credit the note payable for $100,000. Now, if the company has a December 31st year end, but does financial statements semi-annually, you have to make an adjustment for the 4 months interest at the end of the year. So you would debit your interest expense and credit your interest payable for $4,000 based on a calculation of $100,000 times 12% times 4 to 12. Even though the note is actually paid on the next day, right? Because 4 full months, so March, April, May, June 30th is the last day of the period, but the note is actually paid on July 1st. That's what this last transaction is. On July 1st, the company pays the note, $100,000, and the $4,000 of interest. So you're going to debit the note payable to remove the obligation. You're going to credit the interest payable, which was set up as an accrual. That's what that's called, it's an accrual. And you would then credit cash for $104,000, and the note is exhausted, all done. Now, a zero interest-bearing note basically is a note that doesn't have an interest-bearing component, but unfortunately, from an accounting perspective, we have to actually consider interest as being implicit, right? So it becomes part of the accounting, even though there actually is no interest. It represents an opportunity cost, and that's just the way it is. So if we look at this similar example and say that this time Landscape issues a $100,000 4-month note, right, to the provincial bank. So it's a 4-month zero interest bearing note to the bank. So what you would have to do is you now record the note at its discounted present value. Okay, so you calculate the present value using your calculator. You probably should know how to do this using your financial calculator. I'll post a video, it should be there already by the time you view this, on how to use your calculator for a bond transaction. It's already there. If you look in chapter 14, there is a short video on how to do that. But using your calculator, you use 4N because it's 4 months. Now 1 IY is the interest rate because you have 12%, but then you divide by 12 months to get 1% per period, right? So 1% per month for 4 months, zero payment because there's no interest, and a 100,000 future value. If you compute the PV, that's 96,098, and you may ask, well, how come it's not the same as this 96,154? Well, the textbook uses in its illustrations the present value tables at the back of the book. Now you're not provided those for the exam, so you have to know how to use your calculator. The calculator gives you an exact answer, whereas the tables end up with a rounded answer. So this 96,154 is a little bit off due to rounding. So that note is recorded at its present value. Then the interest accrual at the end of 4 months, right, you still have to recognize it. The interest on the note. So in this case, we would take that 96,000. We'll just use the number that they use in the text here, 96,154. If we use the actual number, it would be 96,068 times 12%, right? Times 4 over 12, and that's 3846. So in this case, you would debit the interest expense for 3,846. But look here, we're not crediting the interest payable. We're crediting the note payable, right? Because it's not an interest-bearing note, so the interest there is no interest payable. It's only the note payable. Note, if you kept a T count for the note payable, I've got one down in the corner here, the initial transaction is 96,154 based on the numbers that are used here. And then the interest accrual on that is 3,846. Well, guess what? At the end, right, the value of the amount that you have to pay or that landscape has to pay back to the bank is $100,000, and that's the amount of the note. So the note is issued originally at a discount, right? And then there's an interest adjustment based on that discounted amount to bring it up to $100,000. You will then debit the note payable for $100,000, credit cash, and the note is now exhausted. Okay, so now the next major concept is product warranties. You're very familiar with this. If you've bought a car, a computer, pretty much anything that you buy has some sort of warranty or product guarantee. And it's basically a promise made by a seller to a buyer to correct some problems associated with the product's quality or performance. Right? You can read the rest, but that's pretty much what a warranty is. Types of warranty. One is called an assurance type warranty. It's a fancy term for a standard warranty. And it's basically part of the sales price. So you're not paying any extra for the warranty. So if you buy a car, that car may include a warranty for 3 years or 5 years or whatever, right? And whether you know this or not, you're actually paying for the warranty as part of the purchase price of the car. So General Motors and Ford and Honda, they estimate about how much they think that they're going to have to cover and sort of try to build that into the price, only to the extent to which the market will bear, including some of that cost in the price, and then the rest is an estimate after. So the warranty is typically part of the sales price. You're not paying any extra for it, and there's a liability that's associated with the expected cost that are expected to be incurred to service the warranty, right? And it's best to see it through an example. So I'm showing you. The other type of warranty is called a service type warranty, which is also known as an extended warranty. So if you go buy a car, or if you go to Best Buy and you buy a TV, and the sales person there puts the fear of God in you to buy the extended warranty because your TV is going to fall off the wall or your pipes are going to burst and your TV will get destroyed. So basically it's an additional service beyond the assurance type warranty, and it's treated in a different way. Right? And it's called a revenue-based approach, a revenue warranty, because in actual fact, service type warranties or extended warranties are essentially pure profit for the companies that are selling them. Very few in terms of a percentage of the warranties are actually used. So it's really good money for them, and that's why they push it. So make sure you read these in detail and then proceed to the examples on both types of warranties. So now we'll look at an assurance type, a standard warranty. You can read the details around the situation, right? The warranty is provided with the product or service. There's no fee. All the revenue is considered earned on delivery, right? And we're going to estimate some warranty costs. So Denison begins production of a product, and they basically sell 100,000 units for $5,000 each by its year end, right? December 31st. So to sell 100 machines at $5,000, you have to record that transaction. So we'll say it all happens on one day. We're going to debit accounts receivable, credit sales revenue for $500,000, which is 5,000 times 100 units. Now this particular question also includes some other details, right? So if we keep reading before the box, it's okay, the company provides a 1-year warranty promising to fix any manufacturing problems, and they estimate that it'll cost about $200 per unit, okay? Now it also says, and here's where the part in the red box is, that the company incurs $4,000 in actual warranty costs to replace parts on machines that were sold before December 31st. Right? So this actually relates to previous items. Okay. Well, not really. Okay, so if we go back and look at the first transaction, from July to December 31st, 100 machines are sold, so by the year end. And it's all recorded in one transaction for illustration purposes. So we're not assuming that they're all sold on December 31st. They were sold between that period. But prior to the year end, right, prior to us making an adjustment for the warranty or an estimate, this is one of the ways you can do that here in the second transaction, is you'll debit the warranty expense and credit materials, cash, etc. for $4,000. So we're expensing what's actually been paid because we haven't actually made an accrual. You'll see in the examples that we do later on, we actually would make an accrual and debit warranty expense and credit warranty payable for the $200 per unit times all the units sold, and then actually debit the warranty liability for the $4,000. Here's a year-end adjusting entry, right, to accrue the obligations at the end of the year, right? So in this case, because of the way the question is worded, they sell 100 machines between July and December. They end up paying $4,000 to service those machines, and then at the end of the year they estimate an additional $16,000 in costs, right? So here's where we would debit the warranty expense and credit the warranty liability for the remaining expected future costs. So different questions will be worded in different ways in terms of where this $4,000 comes in. It could be that that $4,000 is actually paid in the next period. Right? So really just you have to read the questions very carefully because they're not all exactly the same. In terms of over here what our financial statement would look like after, we have sales warranty or sales revenue of $500,000. And then our warranty expense consists of the combined $4,000 for costs incurred prior to year end, and then the estimate of cost to be incurred in the future. And the reason why that entire $16,000 is expensed all in 1 year is because it's a fantastic example of the matching principle. Right? Remember, with matching, we have to match our expenses to the revenue. So we've sold these machines, right? And if we think we're going to have to incur some cost to service them, even though those costs will be incurred in the future, we actually have to expense the future costs associated with fixing and warranting them in the period that we sell it. So that's why the warranty expense is a total of all amounts, so $4,000 actually incurred plus $16,000 estimated, and then we have a warranty liability of $16,000, which is the company's best estimate of what you will have to pay in the future. Then we assume that all of the warranty costs, or let's put it this way, that we assume that our $16,000 estimate is right on. And so in 2018, the company actually incurs $16,000 actual costs to warranty it. And so in this case, I would actually prefer that you debit the warranty liability rather than the warranty expense, because what happens here is the liability account to zero. You see, where here now we're having to debit the warranty liability and credit warranty expense. So you see between these two transactions, warranty expense is both debited and credited. It doesn't make sense to do that. So you can actually avoid this with a revised entry that is just a debit to warranty liability of $16,000 and a credit to cash and materials payable, etc. And at the end of the year, you'll see that in 2018, there's no further sales revenue, right? We can assume that the company only sold the product in 1 year and that was it. So there's no additional sales revenue. There's no warranty expense because it's already been expensed, and the $16,000 is a debit and credit, so it's zero, and the warranty liability account is zeroed out. Okay, so now we'll get into a service type warranty, which basically is where the warranty is separate, right? So it's sold as a separate service or an extended warranty. Hamlin Corp sells an equipment package for $20,000, and included is a standard warranty for 2 years, right? And during that 2-year standard warranty period, Hamlin agrees to repair and maintain the equipment, no problem. Then basically there's an option for the buyer to purchase an additional warranty that has a standalone value of $1,200. So what happens here is Hamlin allocates $1,200 of the proceeds of the bundle to the warranty contract. So, right, in this case, right, and this is one type of sales warranty. There's a different type of warranty where it's actually sold as a separate item altogether. But here, the warranty is considered to be bundled with the product. Okay, so you got two options: one where it's either sold separately or where it's bundled. In this example, it's bundled. So your $20,000 sales bundle includes $1,200 in additional warranty. And so this is kind of a sneaky way for companies to build in extra profit unnecessarily without the buyer necessarily knowing. So you're going to debit cash for the $20,000, but that $20,000 is broken up into sales revenue, which gets a credit of $18,800, and now you have an unearned warranty revenue of $1,200. And that unearned warranty revenue sits there, right, until you recognize the revenue. Under this approach, the company performs the warranty under the contract, right? Now, if the revenue is earned evenly over 2 years, then basically what we'll do is we will now debit the unearned warranty revenue for $600 and credit warranty revenue for $600 as well, right? And then we would do it again, right, in the second year. And then if in 2017 costs of $423, this is just an assumed number, right? If $423 is incurred in 2017 as a result of servicing the contract, the company then records a separate warranty expense and credits materials cash or whatever. So what happens is you have warranty expense of $423, warranty revenue of $600, right? Because it's built in as a bundle, right? In a different type of revenue or extended warranty, if the warranty is sold separately, in this case you would have cash and sales revenue of $20,000, and then you have an additional cash and unearned warranty revenue of $1,200. And if that extended warranty is after the standard warranty period, then the second entry for the unearned warranty revenue to be recognized wouldn't actually occur until 2 years hence. So it would be 2019 and in 2020. And you'll see that in some other examples that we do later on. I don't need to say much about presentation and disclosure. You're familiar with this when you did your balance sheets in Accounting 2206. And also in your intro accounting. Basically, your current liability section looks just like it does here. If you have any bank indebtedness, that would be like an overdraft or something that usually comes first, but everything else is typically in order of when it comes due. So your accounts payable, income taxes. The one thing you have to make sure you don't forget is to identify any long-term debt that's due within 1 year. So things like the current portion of a mortgage, current portion of a lease, current portion of a long-term note, whatever has to be disclosed as a portion of it is current, and then the remaining part of it is long-term. And that's pretty much all you need to know about presentation and disclosure. Now we'll talk very briefly about contingent liabilities. Basically, a contingent liability is a potential liability, right? And the best example of something is of a contingent liability is related to a legal issue. So somebody slips and falls in front of your store in the winter, right? And then they sue you. Now the question is, to what extent do we actually have to present and disclose that the lawsuit, right? So basically, under both ASPE and IFRS, it's pretty much the same, except that the word likely that is used for ASPE is replaced with probable for IFRS, and I'll discuss the difference in a minute. So basically, you would disclose a contingent liability in 3 cases. So one, that it's likely that a future event will confirm the existence of a loss, but you can't estimate it, right? So somebody slips and falls, right, and you don't know how much it's going to be. So in that particular case, all you can do is disclose in the financial statements that there is a loss, there is a potential liability, but we don't know how much it is. In the second case, a loss has been recognized and there's an exposure that's higher than the amount that was recorded. So a good example of this is somebody slips and falls. They sue you for $1 billion. And your lawyers think it's only going to be $1 million, and so you would record the $1 million and potentially disclose in a note to the financial statements the $1 billion. In the third case here, it's not possible to determine the likelihood. There's really not much we can do, right? So when I was saying before, ASPE, the word likely basically means there's a high probability and it's measurable, right? So we can kind of estimate what it is. Now, IFRS doesn't use the word likely, they use the word probable. And basically probable means more likely than not. It's a weird term, it is what it is, but it's more likely than not. So there's a chance, there's a good chance, and it's measurable, but the threshold is lower than that of ASPE. So basically, ASPE likely, IFRS probable, and that's pretty much there is to contingent liabilities. So now we'll just wrap up the chapter with a couple of basic ratios. Now you should be familiar with these in your intro course. I'm not going to use any examples, and the formulas will not be provided on exams. So this chapter covers basically 2 ratios you need to know. One's the current ratio, and that's your current assets divided by your current liabilities, and that's it. Asset test ratio, and that's basically your cash plus marketable securities plus net receivables. So there's a difference between that and current assets, because your current assets can include inventory, it can include prepaid expenses. So when you look at cash, your marketable securities, which are basically investments that are convertible into cash very quickly, and net receivables, which are typically turned into cash fairly quickly. So it is a very, very short-term kind of cash ratio, and that's divided by your current liabilities. Again, these ratios or the formulas are not provided on exams. Every good accountant should know them. You should be able to calculate, right, these ratios and comment. So usually one ratio on its own, right, for 1 year isn't very meaningless, or isn't very meaningful. You need to compare against an industry benchmark ratio. So if the current ratio for your business is 1.5 to 1, but the industry average is 2 to 1, well, then your company isn't performing as well, right? Because the industry benchmark is $2 in current assets for every dollar in current liabilities, and you only have $1.50, right? And it'd be the same when comparing period to period. So your current ratio can go from $1.50 in 2017 to $1.75 in 2018. That's an improvement. Same with the asset test ratio, the interpretation is the same. So if you have an asset test ratio and the industry benchmark is 0.75 to 1, so 75 cents, and cash, marketable securities, and receivables to every dollar of liabilities, and you have 0.9, so 0.9 is more than 0.75, so your asset test ratio is actually better than the industry, right? So just be able to briefly comment on the ratios as a comparison from 1 year to the next, or a comparison of firm performance to industry benchmarks. So that concludes the Chapter 13 video lecture. Please be sure to view any other videos that are associated to additional problems, and do as many practice questions assigned for homework as you can. I hope you found this useful.